The Excel file basically shows some statements in terms of the balance sheet, the P&L and the cash flow. All we need to do, and the purpose of this exercise, is to kind of see that any transaction that the company does will leave the balance sheet balanced. Fine. At this point of time, what we are saying is that the company has started its business. Year 0 is what we have. They raised equity of $500 million or 500 crore rupees, and they have cash in their bank account of 500 crore rupees. Now they are doing some business. Each business step is mentioned on the other sheet called business. So there's another worksheet within this Excel file which is called business, and each step says that. Each of these steps will make some changes in the P&L and the balance sheet. The cash flow is already linked. All we need to do is that the closing cash flow of the year 1 has to go and sit here. Correct? So right now, if the company does nothing, then they will have 0 cash flow during the year, and ending cash, which is 500, will get linked to the ending cash of year 1. So balance sheet at the end of year 1 will have the ending cash of year 1. I want all of us to spend about 2 minutes, remember, trying to look at these numbers, try and change these numbers in the balance sheet and P&L. Remember that after every transaction, the balance sheet should remain balanced, which means this particular cell that you see, which is check, is basically a difference of assets and liabilities. It should always be 0 if you have input the transactions correctly in all the statements. Cash flow is already linked, so it will automatically do whatever it has to do. The other linkages after every stage should leave this constant. So just try it for a couple of minutes and then I do it as well along with all of us. As an example, I will do the first stage, which is the company raises about 200 crore as long-term loans at an interest rate of 10%, correct? So what happens in year 1 in long-term loans? Here we will add 200. The moment we do that, we find 200 gets added to the long-term loan. We find there is a loss or a finance cost of 20 that comes in here in the P&L because you have to pay interest on this 200 crore at 10%. You will find this net profit goes and sits in your cash flow. You will find the company has raised debt, and you find the balance sheet is now not balancing. It is not balancing because on this side the cash number is exactly the same. After raising 200 crore as loan and paying 20 crore as interest, you should be left with 680 crore. So this is correct. What is wrong is this side is because the profit number has to go and get added to the reserves and surplus. So effectively this number will become minus 20. The moment you do that, the balance sheet will balance itself. Fine. Okay, let's do it together. So let's look at the next stage, which is the company buys plant and machinery worth rupees 400 crore to begin operations. Now they have raised the money, they have the debt, now they are trying to buy some assets to work. So 400 crores comes in. If you are buying assets worth 400 crore, that should increase your fixed assets, which is your gross block. Gross block is what should become 400. So gross block becomes 400. The moment you see gross block becoming 400, you will see a depreciation and amortization expense of 40 coming here, which makes your net profit minus 60 and reserves and surplus becomes minus 60. However, you find, and you also see that there is a transaction which earlier we started with 680 of cash. That 680 has moved 400 here. So that's a rearrangement of items within the balance sheet on one side. It's still not getting balanced. Why is it not getting balanced? Is because once we have bought the assets at the beginning of the year, we have lost 40 crore of the value during the year. That loss of value at the end of the year has to be reflected in terms of accumulated depreciation, which is the amount of value that has been lost by the asset. The net value of the assets at the end of the year would be 400 minus 40, which is 360. The moment I make that adjustment, I put this 40 here. or I just link this 40 to the depreciation number, I find that the balance sheet is again balanced. That again becomes 0. So the task gets solved itself. Second transaction done. Third transaction, the company invests 100 crore in mutual funds, correct? So they invest 100 crore in mutual funds. That's an investment, which means this value will go up. So investments need to go up by 100 crore. Automatically, as investments go up by 100 crore, you will find cash will go down. Another one of those transactions, which is a rearrangement of items on one side, does not change the overall value of the assets. That remains at 640. Balance sheet continues to remain balanced at this stage. Now the company goes and buys raw material worth 100 crore in the next stage. This stage of buying raw materials worth 100 crore should change the inventory of the firm. It's not said whether they have sold it. They've just bought raw materials worth 100 crore. They would have used cash to buy it. So once again, cash will go down and inventory will go up. That's all that is going to happen. I put 100 here. Automatically, the cash goes down from 180 to 80 and the balance sheet stays balanced once again. Correct? Next, we see after converting raw materials into finished goods, the company is able to sell it for 300 crore. So now we are talking about sales, which means there is a revenue number that is going to come in the P&L. So on the P&L side, we are going to look at the revenue number and we are going to add this 300 to the revenue. Correct? You have sold these goods. If you have sold these goods, there is no inventory left, which means cost of goods sold should go up. So there are three things that are happening. Revenue has come in worth 300. Cost of goods sold should come here, which was 100, the raw materials we bought, and this should go down. Inventory becomes 0 once again, correct? So cost of goods sold becomes 100 and inventory becomes 0 once again. You will note that even at the end of this transaction, because now the company is making some profit, there is a tax element. So far they were making losses, so there was no tax element, and you find that the balance sheet remains balanced. Correct? Next, we quickly move on. Operating costs in this process are 50 crore. Just put in 50 crore in the operating expense number. You put in 50 crore there, the balance sheet stays balanced. No problem, transaction recorded correctly. Profit goes down a bit, tax goes down a bit. Correct? Next, some clients do not pay upfront, so this money worth 100 crore is not received. What does this do? This adds current assets in terms of receivables. So my receivables will go up by 100. My receivables go up by 100. That's again, if you see, a transaction where I had already assumed that this money has come into the account as cash, but now that will flow from cash to receivables because this has not been received. So change in receivables gets deducted in my cash flow. Correct? That comes in. The company delays payment of 50 crore to one of its supplier by 10 years. What does that do? Basically, current liabilities would increase by 50 crore and that increases the cash balance. Why? Because I was supposed to pay this 50 crore. I have assumed that I have already paid in this cost of goods sold, but I haven't. So this is add change in current liabilities. This money is still in my pocket. It increases the cash balance from 203 to 253. Correct? Next transaction, before the year ends, just before that, the company chooses to sell investments worth 50 crore. The market value of these is 60 crore now. So the first thing they do is investments worth 50 crore get sold. So out of 150 gets sold. So the value becomes 50. But the market value was 60, so they must have made a gain or other income, which comes here. In the P&L, there is another income of 10. You see cash balance at this point of time is something like 303. Now if I put in another income of 10, 3 out of that will be taxed, and once that comes in, cash goes to 310. Finally, last statement, the company chooses to pay a dividend of 10 crore. I will put the dividend here at 10, which automatically gets adjusted in my cash flow but leaves my balance sheet unbalanced, is because when I made the adjustment for reserves and surplus only adds undistributed profits. That's what is the entitlement to the equity holder. whatever is distributed as dividend is anyway gone to the equity holder. So what will come in here is going to be last year reserves and surplus plus the net profit minus the dividend. The moment we do that, we have a fully balanced balance sheet once again, which gives us the statement cash balance at the end of the year is 300, balance sheet is balanced, total size being 810 crores. The idea of this exercise is to appreciate that whatever transaction the company does will either change things on both directions, both the sides of the balance sheet. So for example, when they raised long-term loans went up and cash went up, or will rearrange items on one side. So if they had receivables, cash moved to receivables. If they bought fixed assets, cash moved to fixed assets. Correct? There is no reason for the balance sheet not